Taxes, the economy, and the impact of AI are where investors are focused. Joining us at the NASDAQ market site, we have Michael Normile. He is U.S. economist at NASDAQ, Max Cabasso, managing director on NASDAQ's market intelligence desk, and Chris Englebert, managing partner, managing co-founder, and CIO of Englebert Investors. It is great to have all of you with us as always. Those are three big topics that we have to unpack. I would go with, taxes, what's happening in the economy overall. We're in tax season now. Yeah, we're in tax season, Jill, but the other thing is obviously we've just had a landmark decision by the Supreme Court, the tariffs possibly, who knows if they're overturned for sure or not. But really, what a lot of people forget about in last year's story was the big beautiful bill. And personally, I think the big beautiful bill was good in some parts, and others maybe didn't go enough as far as spending goes. But what it really did for the average investor, the average consumer, is they're going to be getting one of the largest tax refunds literally in history. So a lot of people over withheld, tax rates didn't change, and all of a sudden they're going to be getting this windfall sometime on April 15th that we actually think is going to help the economy, but the question is, will it lead to some inflation? Yeah, and it's a very good question. And, Michael, from your perspective, how are you viewing what's happening with more income or more tax returns coming to investors and consumers? Yeah, I think it's another support for the consumer to keep them spending this year. Obviously, the big theme with consumers for the last couple of years has been that K-shaped consumer. Mm-hmm. Right now, the estimates are looking for those tax refunds to be about $1,000 bigger on average, so a lot of money. But when you get back to that one big beautiful bill act tax cut that you're talking about, it does scale with income. So people on the higher end especially, they get the bigger tax benefit. Part of that is because people on the very low end, they already don't pay a ton federal taxes, but people on the high end obviously spend more, and the tax breaks help them more. And so it really should perpetuate that K-shaped consumer that we've seen the last couple of years, where you're looking at over a 3% boost to after-tax incomes for the top 20% by income. But that top 20%, they do about 60% of all spending in the U.S. So it's enough to keep overall spending growing, even if the tax benefit is tilted towards people on the higher end of the income spectrum. Yeah, and it's interesting, Max, we always say that the economy is not the market and the market's not the economy, but it feels as if, since the start of this year, that perhaps the market activity is catching up with how people interpret the economy. The market is, I think, trying to come to terms with what it is versus what it wants to be, and figuring out where things go. We talked for so long about, like you said, market is not the economy is not the market. It was all Mag 7 trade, everything was pouring in there. Under the surface, things weren't as great. Now you're starting to see that you kind of reverse a bit, a lot of big rotations going on. Again, semiconductors are picking back up, they're seeing that strength. But even earnings have been pretty good, for a lot of companies, and strictly depending on where you are in which sector, it tends to not really matter. Like right now, software, even if you're putting out big prints, beat, raise, guiding higher, you get a quick pop, but then something else comes out and you're getting taken down. So I think there's a bit of confusion. Again, basic materials, financials have actually done terribly, not terribly, but not picked up with everybody else. So we're starting to see, I think it's turning into more of that stock pickers market versus what it used to be, where it was just index, ETF, Mag 7, that's your trade. We talked about it for years. Yeah. Where would the market be without it? I think we're actually starting to see it kind of turn now, where that Mag 7 is not leading the way. The other 493 are starting to pick up. But again, it seems to be really sector driven, and you're going to have opportunities, the second part of the year to really be a stock pickers market, to find these companies that are actually performing, and a lot are. They just haven't really seen it read through into the stock prices, again, based on the sectors. Yeah, and Chris, that's been a consistent theme on here, whether we have economists come on, strategists come on, that this is a stock pickers market. However, I think this really speaks to diversification in one's portfolio, because you have to pay the piper at some point. Yeah, and we deal with defined benefit pension funds, and a lot of them have a target of 60% S&P 500, 40% Barclays Ag, and that's been the standard. It's been outperforming. Well, we're reviewing some of our pension funds today, and one of the things that we did last year is we started increasing commodity exposure, a couple of different commodity ETFs, 2.5%, 5% commodity exposure, sector exposure, capitalization exposure. I mean, we've been on the show for a long time, and last 2 years I've been pounding the table on small mid-cap stocks. Guess what? That's the area that's really beginning to explode. But
back to your point, Jill, everybody got focused into this whole Mag 7 trade, and now there's literally only one stock in the Mag 7 that's outperforming the S&P 500. Now, do I think, maybe they're a little bit oversold at this point? Probably. We could see some kind of bounce back, but I really think that the average investor all of a sudden only had one trade that he had to do. Hey, Mag 7, that's what I'm going to do. Well, now they're beginning to understand we got to diversify. We got to do some commodities. We got to do maybe some value dividend stocks. We got to do some small mid cap. Oh yeah, don't forget our bond portfolio too. And we're going back, I hate to say, to a more traditional asset allocation format, but I think it's healthier for the market to have that versus just that super concentration in a narrow sector of stocks.
Well, from a fiduciary perspective, if you're managing pension funds, you can't go all in.
Right.
I mean, that's just the model.
I've said that for the last couple of years. I said if I would walk into a $1 billion pension fund and say, hey, we're going to have 60% of your money in stocks, and oh yeah, 40% of that 60 we're going to have in 7 stocks, you would have been like, we're not going to do, we're not going to do that. But that's the trade that's worked. But now we're beginning to see, I hate to say, and our theme, if you've watched, obviously our viewers have watched the show before, our theme for this year is return to normal. And we think that's part of the return to normal.
Yeah. Well, Michael, I mean, a significant amount of CapEx is now showing up in GDP as well. And we've seen adjustments to those CapEx numbers. How impactful could that potentially be?
It's pretty impactful. I mean, we're looking at, just for those AI hyperscalers, the 5 big companies investing in data centers. It's going from $450 billion in CapEx spending last year to over $650 billion this year, so $200 billion bump there. You go back to 2020, their CapEx was under $100 billion, so just a massive increase. And then in terms of how that flows through to GDP, about 70% of that CapEx spending on data centers ends up in GDP. And last year, it was about half of the economic growth was that tech investment, the other half was consumer spending. And it looks like 2026 could look a lot like 2025 in that sense, if we're seeing that boost to the tech investment alongside the One Big Beautiful Bill Act tax cuts boosting consumer spending, that we might see a pretty heavy tilt again with consumer spending driving growth and tech investment driving growth.
I mean, that is the perfect storm for a good outcome. Max, this show, obviously we focus on more long-term themes. I think the move that we've seen within the tech space because of how AI could disrupt it, I personally think that's a bit short-sighted. I don't think companies, we could use financial services and healthcare, heavily regulated spaces as an example, are going to blow up their entire tech stack and have their proprietary models and data exposed on open source platforms. I just don't think that's going to happen, at least now.
Yeah, absolutely. I think it's very short-sighted to think that somebody in their basement is going to vibe code something to replace all of these legacy systems that also have AI and engineers and have a track record of security that are working with enterprises that are established. You're not just going to replace everything. And we just saw it with the government of Mexico getting hacked. Somebody was using Claude Code to essentially hack the government and pull hundreds of millions pieces of data from the government. Infrastructure security is not going anywhere. It is very short-sighted to think that they're going to be taken down. Margins maybe will compress, but again, I think those legacy providers that are in there now that have that built up goodwill, that trust, they're in the fabric of these companies. And to think these large-scale enterprises are going to strip all that out to try to save a few bucks, then they have to operate it themselves instead of having experts in the field run it that are already there. I mean, you're seeing it. Companies are talking about now. We did an analysis on a variety of technology companies, what they were saying on their earnings calls, what analysts were kind of pressing them on. So the analyst community is now pushing back on ROI and are you actually going to get displaced here, or is this going to be a tailwind for you? And that's where I think they're starting to piece it together. There's going to be losers, but there's going to be winners. Not everybody's going to get kind of thrown out here. There are that are going to integrate it into their system, into their product, and they're going to ship quicker than anybody else. So again, somebody might be able to create some sort of competitor quickly in the basement, but the complexities are not going to be there. And those, again, the legacy providers have that expertise. They're going to be able to use the tools as well to ship products that are more secure and that are even faster than something built, kind of on a two-person shop. So I think that software is dead sort of trade is very short-sighted, and I don't see that playing out in 5-10 years. Again, there will be winners. There's going to be losers as well. Not everybody's going to be a loser.
Yeah, I mean, Chris, that's every cycle, though, you could argue. And I think, you and I talk about this off camera all the time, but I think the competitive edge longer term is going to be models that are built privacy by design and security first.
Yeah. Yeah, no question about it. I mean, it's one of those things like Max was saying. I mean, we've been looking at some of these stocks, which we haven't touched in a long while because the valuations were so high. The valuations are getting back to being, more interesting at this particular time. But again, every industry sees the same cycle where there's, this potential disruption. I mean, we're seeing it, with the custodians, that somebody's going to be able to use AI to read your tax returns and give you some strategy. We actually think that's a good thing, and we've been exploring that as a registered investment advisor. Like, you bring your tax return to us and we're saying, hey, Jill, if you put in X amount into your 401k, it's going to save you this much. It's good
for efficiency purposes.
Right, and it's going to be very efficient because we're going to be able to, give you information that before laboriously. I mean, we tell our clients all the time, hey, when you talk, we're not trying to replace your CPA, but when you talk to your CPA, have them run these scenarios. CPAs are very busy doing that, but if we as a registered investment advisor could be like, here's the strategy you want to do. Now, one of the other products that's come to the forefront, which is really taken off, has been direct indexing with tax overlay. Incredibly efficient. It's always been around, but it used to be quarterly rebalancing, then monthly rebalancing. Many of these direct indexers are daily rebalancing, and if you would see in a taxable account, the tax efficiency, it's mind-blowing. So and that's only due to the fact that they're using some of these products around the edges to be able to look at a portfolio and say, okay, Exxon's down today, Chevron's up, we're going to sell one, buy the other in order to create tax efficiency.
Yeah, it's interesting, Chris. Max, there's a paradox here. While it creates efficiencies, you don't want to be too reliant on what it's saying, especially when you think about your health, when you think about legal matters as an example. It actually creates more work for the experts if you're coming in with AI-generated material that might not, have the expertise that trained professionals do.
Absolutely. I think it's a great supplement, but you always got to check your work. I always like to test it with things that I know myself and confirm that I know 100%. You test it and kind of see what the answers are, especially for us over here. I cover almost half of our NASDAQ 100. I'll have it run some analysis, try to pull different data, and it'll give me responses. I'm like, I know that's not true. Run it again, run it again. So again, it can be helpful. It's absolutely going to be an efficiency boost for users. It can help you in those kind of edge cases, and it's going to get better and better and better. But at least in the short term, you still have to check your work. You don't want to have to go back, correct mistakes. So again, to think that this is all going to displace all these names that have been getting absolutely crushed over the the past few months, especially in the software space, that's all going to happen in the next 18 months, 2 years. I find that very, very hard to believe. Now again, the market is supposed to be a forward-looking indicator, so maybe again margins will compress. It's a useful tool. It's going to get better. We're going to see this productivity gain, but how much? And again, you have to be able to check your work because a lot of times it spits out answers that might sound right, but they aren't always there. So you still have to check that work. Again, taking that to somebody that knows what they're doing, your CPA, your investment advisor. Hey, I ran this. I was able to see it. What do you think about it? And you kind of go through it. And again, so maybe instead of starting at 0 on a scale of 1 to 10, you're starting at 3 or 4. So it saves that 1, 2, 3, but you're still not going to get all the way there. And that's where I think, again, it'll be an efficiency boost. You're starting here instead of here, but it's not. You're not getting from 0 to 10 on
it's not
one shot.
It's not a replacement.
It's a partnership in a way.
It's a partnership, not a replacement. And I think really what ends up happening with all technology, and this goes back to the days of the internet, we give too much short-term emphasis to it. And in the short term, we overemphasize it, but in the long term, we underemphasize it when we should actually be doing the opposite.
Well, I mean, it needs to be balanced. Oh, I'm sorry.
I think it's similar to kind of what we saw during COVID days with trading. You're seeing a lot of videos on X, I'm sure it's on TikTok and Instagram, of, hey, I just one-shotted this. I vibe coded this in one shot and it's there. It's like the winning trades you used to see, where it's like, look, I bought these calls and I'm up 10,000%, and okay, well, what about the 100 other trades that you were just kind of grinding away, hoping for this lottery ticket, and this one hit, you posted that one. What about the rest? What about the 15 hours you spent trying to build something that didn't work? I think we're seeing a lot more of that, of kind of feeding into the hype of, look, I can one-shot this new app, it's perfect, everybody's going to use it. Again, what are the others that you're not showing? And I think that's building into this hype, but we're only seeing the ones that have worked.
Yeah, and Michael, it's interesting because Max had brought up ROI and how that's going to be benchmarked and measurable. I don't think anyone's able to answer the question yet, like how do you value data? It's still very arbitrary and subjective at this point, depending on how you're using it.
Yeah, I mean, it's a really difficult question, and it's also the question that we get to, especially related to AI, is how do you measure its impact on the economy? What's the metric for companies to use? Because a lot of it is just survey-based when people are saying, I think it saved me some time right now, and that's kind of what a lot of the measurements we have so far. It's really a lot of survey data more so than any kind of hard data that we have, where it's people saying it saved me 1 to 3 hours, it saved me 4 to 5 hours, 10 plus hours, whatever. So it is still kind of squishy data that we have on how much it's actually impacting productivity or saving people time at this point. I know there's things where I've tried to use it, it's definitely wasted time for me. So it's really all over the map, and it's very challenging to measure it, really.
Well, I mean, I think when the pendulum swings back to the middle, that we should also emphasize you're a classically trained economist. You should understand the data that you're looking at and be able to articulate it in a way, instead of having a new crop of people come in, and it's so heavily dependent on efficiency and AI platforms, and all you need is one mistake in the data.
I think that is a big thing about my experience using AI, because you need to understand its output. So if it's coding for you, like you're saying, it's better if you're a software engineer to be reading the coding output than if you're someone who's not trained as a software engineer, right? Or if it's economic data, economic analysis, you need to have that context to interpret what's coming out of it. Otherwise, it's just something spits out some work and you're passing it out as if it's right without doing that kind of background work or having that context to understand it. And it's that background knowledge to be able to say, this part needs improvement, this part is wrong, this part's right. And so I think that is really helpful. It's because there is all this talk about how is it impacting the economy, how is it impacting jobs. There's data that was kind of showing maybe entry-level software engineers were taking a little bit of a hit. There's more recent data that shows that that's kind of normalized, but maybe it is, in the end, we'll have fewer software engineers, but you still need someone with that knowledge base to review what its output is and make sure that what it's doing makes sense.
Yeah, I agree with you 100%. By the way, 3 minutes. We got to talk about the Fed.
Right.
What do you think happens next?
Well, I think obviously we have a Fed governor change in May. Our theme, return to normal, short rates come down, long rates go up. But again, I made the mention about what's happening with oil, and if I was a Fed governor, I'd be, really watching oil. Oil's breaking out.
Yeah.
It's had 9 weeks of relative strength. We haven't really talked about what's happening in the Middle East, but there's some talk out of the Fed that maybe they're done lowering short rates for this year. I could make that argument because, again, if we start whiffing inflation, they may just be on hold until the third or even the fourth quarter, to a surprise of a lot of people.
Yeah, but I mean, oil, it feels like it's ancillary to that. It's not necessarily about inflation. There's specific instances pointing towards, volatility in the region.
Right. Well, but the same, if you do get an oil shock, what ends up happening is, people watch the price at the pump, and that's their inflation indicator. And if they see gas go from $3 a gallon to $4 a gallon, they might pull in spending. And obviously the K-shaped consumer, I'm a little bit more worried about the high-end K-shaped consumer, because they watch TV and they're like, wow, something bad's happened. I can't spend any money. And then you have spending going off the cliff. And declining, and then now all of a sudden, we're getting into the third quarter. So, I keep saying we are entering the month of March, which is the second most volatile month in the stock market. The first is October. Last year in March, the trade war started and we rolled over dramatically. We might see part 2 of that happen, depending upon what happens in the next 30 days in the Middle East.
Yeah. What do you think in terms of monetary policy?
It's an interesting spot that we're in, because like you're referring to, we got the latest Fed minutes, and there was talk where some members of the Fed were actually saying, we're open to changing the language to say that the next move is a two-sided decision, meaning a hike or a cut is on the table. And the reason being that they're starting to see that stabilization in the labor market, but we just got the latest PCE inflation. We're looking at 2.9% headline, 3% core, and so that's obviously well above the Fed's target. We're in an interesting position right now where PCE is still going up a bit while CPI has been coming down, but of course the Fed's target is based on PCE. So there is some justification for them saying inflation's too high, labor market's stabilizing a bit, maybe we should sit on our hands a bit and just kind of wait and see, and that seems like that's the general consensus. But where are we 6 months from now? Does that mean that a cut is looking more realistic? Is a hike looking more realistic at that point? So it really depends where things go. I'm optimistic that that inflation data for PC is going to start breaking lower, and that it will be easier for the Fed to go ahead with those cuts.
And Max, last 30 seconds here. The market seems to be pretty neutral on in which direction.
Yeah, I mean, I think right now we got 2 cuts priced in for the year, but there's not one particular meeting that I think is above even 16, 17% right now. So it's kind of just the summation that's building in there. Again, I think I'm kind of in Michael's camp here that, optimistic. I think the market's optimistic that that's going to roll over. We haven't really seen that impact the consumer too much. Geopolitics, though, like you said, is going to be a big factor. If something happens in the Middle East and oil spikes, that could change. Now, again, they always talk about outside of volatile food and energy, but that will have an impact on prices if we see energy really start to rip higher. And again, this is kind of an uncharted territory with them. With AGI, is that coming? AI, what's it going to do to the jobs market? So I'd be surprised if they were leaning at all towards a hike in the face of this potential job loss everybody keeps talking about might be coming with AI. Be surprised if they were hiking in the face of that. Again, we'll see if inflation really starts to pick up. We could see it, but I'd be more in line of holding until we get later in the year, they get a bit more data, and then kind of leaning towards that cut.
And then, of course, we have midterms coming up as well. Yeah. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.